We like to say we put a couple of extra cherries on top. We're always asking ourselves for ways that we can go the extra mile for our clients. The fourth core value is we are resilient. And in the words of the famous rapper and philosopher Jay-Z, we consider the setback the setup for the comeback. So demonstrating resilience in our crazy world is an important thing. And we have a growth mindset that's in our DNA. We want to grow our business, but we want to grow as individuals also so we can serve you better. I'd like to draw your attention to the chart in the upper right. We normally don't show that, but last year we hit a critical milestone for Parr McKnight. We crossed $1 billion in assets that are supervised for clients. And, I call that a billion units of trust because it's not about the money. It's about the trust our clients place in us. And that growth has come not by accident, but we are not interested in crazy, wild growth at Parr McKnight. I'm going to hold up a book called Small Giants that had a big impact on the way we view our business. And it's about rejecting Western civilization's mantra for growth, 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 money, 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 bigger, 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 bigger is better. We want to stay intentionally small so that we can stay close to our clients, close to each other, and close to the communities that we operate in. So it's not about growth at all costs. We're 16 employees, and you'll see a number on there, 8 new families. That's our goal this year, is just to work with 8 new families, one family at a time, just to make sure that we stay close to everybody, stay close to the community, and grow at a very measured pace. So that's just a quick update on Parr McKnight. I'm going to turn the floor over to Brian McKnight, and Brian will give us an investment update. Brian?
Great. Thanks, Tony. Good afternoon, everyone. Here at Parr McKnight, most of you know that we're really a planning forward firm where we take your e-money plan or your financial plan is really the thing that we lead with in helping families look at where they're at, where they want to go, and how to get there. But we're also in charge of a tremendous amount of assets on behalf of those clients. So supervising and helping manage over $1 billion of assets, we got to have a good idea of where the market is, why it's there, and how you should be thinking about allocating your capital. So I want to just touch on a couple things today. This is a look at the S&P 500. This goes back to 1997. At that point in time, the market was at about 750. And today we're just pushing up against 7,000. So over the last 30 years, you've gotten in excess of 10 times your money, or 9 times your money, almost 10 times your money, by investing in the stock market. And over that period, that's come with some very big ups and downs, right? As many of you remember March 2000 and Y2K, the market peaked and then declined 49% over about an 18-month period, and we bottomed in October of 2002. Now, if you have $1 and you lose 50 cents, you have to earn 50 cents back or 100% rate of return to get back to even. And that's what happened over the next 5 years. In fact, we just got a hair north of even, and the global financial crisis ensued in October of 2007, and we dropped 57% in 15 months. Again, bottoming in March. From then forward, over the next decade plus, I called this the most unloved bull market of all time because we'd had 50% peak to trough declines in the previous decade. Everybody was waiting for the next drop. And you can go through these long periods of time. In fact, there was 13 years kind of straight across from 2000 to 2013 where the market was essentially even. We call that the lost decade. From there, we went on to new highs as much as everybody hated this bull market until February of 2020. Everybody learned what coronavirus was. We dropped 34% in 34 days. And if you blinked, we almost recovered as quickly. Market went on again to new highs into 2022. That summer, we had 9% year over year inflation, leading to a decline of 25% over about 9 months. And then again, on to new highs. Once the Fed started cutting interest rates, we started fighting inflation, largely to to effect. We had another decline last April that's not as highlighted on here, but I'm going to point it out. It's the tariff tantrum, right? Everybody knew Trump ran on the platform of he was going to impose tariffs. Everybody thought it was going to be 10%. It happened to be 30. Market decline 19% peak to trough, but then again, bounced back almost as quickly. So a couple things have happened. We used to have longer drawdowns in the market and taking lot longer periods of time for it to rebound. It seems like that's consolidated recently into sharper declines that rebound much more quickly. So just something to keep an eye on there. Second, market valuations today, we're at 22 times earnings. So for every dollar in earnings, you're now paying $22. I think this is on the high end of the historical average. I'll talk about that in a little more detail in a second. But we're a little cautious as you come to Parr McKnight with new capital. I would say take your time getting invested. We don't have to decide that today's the new floor in the stock market for putting that money to work. So take your time getting invested there. If you're already fully invested, stay invested. If you're looking to raise capital, maybe we look to raise that from some of the more expensive asset classes. Let's see. The S&P 500 is the 500 largest companies in the U.S. stock market, like I mentioned before. But the composure of that stock market, or the composition of the market, has changed. And these are the top 10 companies through the 80s, 90s, early 2000s, 2000 teens, and the 2020s. And a couple things I want to point out. Number one, leadership in the market changes over time. The same companies that were leading, or the largest market cap companies in the 1980s, are not the largest market cap companies today. Secondly, a lot of people think that inherently you're diversified because you own an S&P 500 index fund. Well, right now, 40 cents of every dollar are in these top 10 companies. It's the largest percentage ever in the top 10 companies in the last 50 years. Secondly, all of these companies, except the top two in here, and by the top two, I mean the two with the smallest market capitalization, JP Morgan and Berkshire Hathaway, are technology companies. And this is a part of this whole AI story, the whole AI infrastructure build out, all the what people are referring to as the whole new wave of technology build out that Don's going to talk to us about today, of all the infrastructure that's being spent, all the capital expenditure and investment that's coming in, putting all this technology in place. So just a couple things here. Be cautious of, I own an S&P 500 index fund. I'm very diversified. 40 cents of every dollar is in 10 companies. Your other 60 cents is spread over the remaining 490. And don't feel like you have to chase all of these companies. Leadership will change again at some point in the market. And just because we don't think this might be the best opportunity right now, doesn't mean that there aren't other opportunities in the market. So where are we looking? We're looking more globally for those opportunities. This goes back to 1975. This is rolling 3-year returns of the US market versus the rest of the world. Here's this zero line, and anytime this purple mountain chart is above the zero line, international markets are outperforming. US markets are outperforming when the purple is below the line. Well, what's been the story for the last 15 years? US markets have been outperforming, right? That's all those technology names. Part of the reason is all those technology companies are domiciled here in the United States. It's part of that American exceptionalism with the growth in technology and innovation, and that's really led the way. But this underperformance by international markets has led to what we believe to be an opportunity today. We couple that with any time international markets have outperformed, also coincides with when the US dollar is in decline, represented by these gray shaded areas. Well, what's happened in the last year? The dollar has been in decline. Trump has come out and stated that one of his goals is for the dollar to weaken against foreign currencies. So we think this is one of the areas that offers an opportunity. And you had outperformance that started to lead the way last year with international markets outperforming the US for the first time in many years. We think this may continue. And here is a continuation of that story. So looking at valuations, first on the left-hand side, here in the US, these gray bars represent the range in your price to earnings multiple over the last 20 years. The little gray bar that goes across the middle That's your average over that 20-year period. The blue diamond is where we were at the beginning of 2025, and the purple diamond is where we are currently. So the US market is on the upper end of its valuation range. But if you look at Japan, if you look at the Eurozone, if you look at emerging markets in general, or specifically China, there's opportunities across the globe from a valuation standpoint. Now, if I take all the rest of the world and I subtract the United States, that's what this index is over here on the side. Historically, the rest of the world trades at an average discount to the US of 19%. But currently, as a complete index, there's a 32% discount. We think that offers an opportunity. And if you look at sector by sector, each one of these areas broken out, every one of the sectors is trading at a discount to the historical average discount to the United States. So again, that's where we see some opportunity. That's where we see some capital being put to work. It's going to maybe give you less volatility in the short run, and better long-term returns when you can get in at cheaper prices. Just to kind of look again at this, there's a lot of numbers on this slide, so I'm going to point you to the lower right-hand corner. This is the forward PE versus your 20-year average. Again, large cap growth is trading at 145% of its historical average. So you could have a 45% decline and you'd be at the average. There is some opportunity in small and mid cap relative to everything else, okay, especially on the growth and the core side. So one of the strategies that we use at Parr McKnight is in that small and mid cap area. Again, from a valuation standpoint, there is some opportunity there. So everybody's drawn to the large cap growth. It tends to be the exciting names. It's the AI driven names, and for good reason. There's a lot of money being invested there. There's a lot of money being invested by those companies. This on the left-hand side is the CapEx from your major artificial intelligence hyperscalers. So Alphabet, Amazon, Meta, Microsoft, Oracle. They were investing $71 billion a year in 2019. By the end of 27, projected to be over $600 billion a year. So a huge amount of investment is taking place there. So again, it's not don't own these companies, it's just own them in the right allocation based upon your goals, your objectives, and your plan. I'm going to stop there. Tony, anything you want to add before we turn it over to Don?
That's great, Brian. Thank you. I always learn something from you. And just to recap, growth stocks for growth. Brian showed a chart, 10x almost over 30 years. But it was Mr. Toad's wild ride. We use dividend stocks for quiet compounding and increasing dividends over time. International is at a big valuation discount to the US. It's not like it's calling for a huge overweight, but we call for appropriate diversification there. And then statistically, really the other cheap area of the market is small cap. So it's not about going to what's hot right now. It's just about owning good businesses for the long haul and realizing that it's going to be cyclical. So I have introduced Don Luskin a number of times, but I'm simply going to say he's been around for a long time. He's been an advisor to Parr McKnight for a number of years. You all receive his advice through us. He's made a number of awesome calls over the years. I was looking at a slideshow from a little while ago, and Don, you had said tariffs. Everybody's making a big deal out of these things. We're not going to see inflation from tariffs, and guess what? We didn't see inflation from tariffs. So we're going to talk about that. But suffice it to say, Don has been an advisor to 3 presidents, and Don, I think you said you were in the Bush White House hanging out with our new candidate for Federal Reserve Chair. So with that introduction, I'm going to turn it over to you, Don.
Well, thank you. That's great, Tony. And Brian, what a great presentation that was, too. On Friday, the Supreme Court of the United States struck down the tariffs that President Trump had ordered under the International Economic Emergency Powers Act. And the court's decision was based on a very simple observation that whatever it is that the president holds out as his hopes for these tariffs, whether it's to create revenues for the government, whether it's to negotiate trade deals, it doesn't really matter. The Supreme Court made the decision that reading the text of this law, it does not allow the president to impose tariffs. It's just as simple as that. The word tariffs isn't mentioned in it. And this was clear more than a year ago from the very first time President Trump tried to do this. And the first lawsuits started to get filed about 11 months ago. The administration lost in a series of lower court rulings, went all the way to the Supreme Court, and has now lost the big one. It's over. These tariffs are gone. The president claims that he has negotiated a number of very advantageous trade deals for the United States because of these tariffs. If you go right now to the website of the U.S. Trade Representative and look at the page on that website where it lists all the trade deals that have been done over the last year, you will see 9 of them. They're all with fairly small countries. You won't see anything with Japan. You won't see anything with Britain. You won't see anything with Europe. You'll see things like Malaysia and Vietnam. And those trade deals, indeed, did improve trading conditions for the United States in some sense. In all cases, the counterpart countries agreed to lower their tariffs against us to 0. And they agreed to fix other non-tariff barriers to U.S. exports into their countries. That's great. That makes the world a better place. But they agreed to do that because Trump was threatening them with 40 or 50% U.S. tariffs on their exports to us. Now, in the negotiation, we settled in all cases on a 20% tariff. But before that deal was done, the tariff was like 2%. So here's what we got out of these 9 trade deals. We got an opportunity for our exporters to have better luck in places like Vietnam and Malaysia. But we have imposed a tax of 20% on everybody who gets anything from Vietnam, Malaysia, Indonesia, Singapore, Argentina, all 9. So for the advantages of our exporters, who can now export more easily to these countries, now all of us who get the advantage of importing things from those countries are paying a 20% tax. So I think that's a pretty bad deal. Now here's the good news. The good news is the Supreme Court just struck down Trump's ability to impose that 20% tariff. So right now, those trade deals just got way better because these other countries have agreed to lower their tariffs to 0. And now we're not imposing 20% tariffs on our own importers. So Trump promised originally that he wanted to get to reciprocal tariffs. If they'll go to 0, we'll go to 0. This isn't the way he thought he was going to get there. But thanks to the Supreme Court, he got there. These are now better trade deals for them. They're better trade deals for us. Now, the president doesn't see it that way. The president, I don't know what he believes, but at least he says that he believes that when we import something from Malaysia and whoever the importer is pays a 20% tariff, he does not believe that it is a U.S. person who pays that tariff. Oh, I guarantee you, if you import something, it's you who pays the tariff. It's not Malaysia. So freedom from that tariff is a tax cut. When those tariffs were in place, we had a tax hike. So this is in every dimension a wonderful thing that the Supreme Court has done. It's made these trade deals better, and it is effectively a tax cut for the United States. Now, this opinion from the Supreme Court came out on Friday morning at about maybe 10 o'clock Eastern time, at about 1 o'clock, and the market was open when the decision came out. The market went up a little bit, but not a lot. And when a big news item comes out like that and the market doesn't respond very much, okay, any of you who've been around markets for more than 15 minutes knows what that means. That means the markets already had it pretty well figured out. So markets make big moves when there's some big surprise. Well, this was a big event, just wasn't a big surprise. So markets didn't move a lot. So now Trump starts speaking. And he has just been dealt a big defeat. It's humiliating for him. It's not just him, any president in that position. Joe Biden found himself in the same position in the previous administration when the Supreme Court overruled his wish to forgive $1 trillion worth of student debt. This happens to presidents all the time. And they always have this problem of, how do I save face? How do I turn this defeat into a victory? And the way Trump did it on Friday was to say, okay, well, the court's decision was big, but really very narrow. It says I cannot impose tariffs under this one law, i.e. EPA. However, I've got these other two laws, 4 sections under these other 2 laws, which are listed out here, that have allowed presidents ever since 1962 to impose tariffs. They've never been questioned in court, so I'm just going to use them. Okay. In fact, he in his style, he went on to say the tariffs will be even bigger and better and bolder, thanks to this. So thank you, Supreme Court. You think you beat me, but you didn't. Fair enough. That's politics. So what are these other laws under which Trump might impose tariffs instead? The first one is called the Trade Expansion Act of 1962. Now, George Orwell in 1984 is probably the guy who came up with that name, the Trade Expansion Act. Okay, this is the act that allows the president to shut down trade by imposing tariffs, but it's the Trade Expansion Act. Nevertheless, it has a section called Section 232 that allows the president not to pick countries, but to pick things and put tariffs on them. So every president since JFK, when he was in office when this law first passed, has used this for something or other. This is where Trump's steel and aluminum, semiconductor, pharmaceuticals, and furniture tariffs come from. These are tariffs on things, not countries. These have never been subject to judicial challenge. They're pretty rock solid. And sure, Trump's right that he can use them, but he left one thing out. He already used them. I gave you the list. Semiconductors, pharmaceuticals, steel, aluminum, copper, furniture. Okay, well, what else is there? So the IEEPA that he used for his Liberation Day tariffs, where at just seemingly his own idiosyncratic discretion, he would impose tariffs of any amount he wanted, on any country he wanted, for any reason. He even on April 2nd, on so-called Liberation Day, imposed tariffs on little islands that had no people on them, just penguins. So 40% tariff on the penguins. They were not happy, I can tell you that. So this law has never been questioned. But those Liberation Day tariffs under IEEPA, that was a bazooka. This is a pea shooter, and he's already shot it. There's another law, the Trade Act of 1974, that has 3 relevant sections. I'm going to take them in reverse order here, Nelson. Section 301 is called the bad actor section. That's where you identify a country that is a particularly egregious violator of free trade principles. So we're all thinking China, right? So in Trump's first term in 2018 and 2019, he followed the law and had his Commerce Department do a big study, what amounts to kind of a criminal investigation of China. And they have to conduct this study for like 6 months, and then when they have to make the study public and give China a chance to respond. So it's this long, tedious process. But they found China to be stealing our intellectual property and engaging in industrial espionage and all kinds of things. And I'm willing to believe that, yes, indeed, China did that. But that was the substance of the China tariffs in 2018 and 2019. Those continued under Biden. He actually added to them, and Trump has added to them in the second term. So that's a fairly bulletproof section he can use. Problem is, who else is a bad actor like that? I'm kind of missing the industrial espionage that Switzerland is engaging in, or the theft of intellectual property that's happening in London, England, right? So it's going to take him months to do these studies. They're going to turn out to be substanceless. The other countries can fight him. It can fight him in court. So, again, a pea shooter. Section 201 is a section that allows him to respond to particularly dangerous industrial problems in the United States. So things where dumping from foreign competition threatens to drive extinct an industry here. So in his first term, he imposed tariffs under Section 201 on washing machines and solar cells. Okay. Maybe this time he can impose tariffs on washing machines powered by solar cells. But this pretty much just overlaps with Section 232 of the other law. Now, Section 122, that's the one he's already invoked as of his press conference on Friday. The executive order was put on the website as soon as he was done talking. This allows a president to put a tariff of up to 15% on every country. You can't pick and choose. You have to have the same tariff level for every country for 150 days. And once the 150 days is up, you don't get to do another 150 days. You have to go to Congress and say, can I please continue this? So he went ahead and did this. The 50 days is going to be up on, I think, July 2nd, which puts it 102 days before the midterms. So these are his pea shooters. We have seen peak tariffs. Now, you can feel free. People make all kinds of arguments about how to manage trade. You hear arguments that, well, all this 50 years, when for 50 years, ever since 1974, it's actually 52 years now, we've never not had a trade deficit in this country. And so, the industrial base has hollowed out, and the middle class is dead. And if we ever got into a war, we wouldn't be able to defend ourselves anymore because we don't make enough steel here anymore. And okay, you can make whatever arguments you want, but in the meantime, the American economy, despite 52 years of trade deficits, started out as, and now is more than ever, the largest economy in the world. And we are by far producing more industrial output today than we were 52 years ago. We're just doing it incredibly efficiently with fewer workers. So it's very, very hard to make the argument that these trade deficits have done anything but help us. And to the extent that they've helped other countries, China, okay, so they got their problems. That's a big communist country. But India, that's an equally large population country that's a democracy. During those 52 years, those countries and others have lifted themselves out of Stone Age poverty because the United States has been willing to be the sponsor of free trade throughout the world. So everything in life is a trade-off. I think that's been a pretty good trade-off. So I am anti-tariff. I am pro-growth. I think tariffs are taxes. Same thing John Roberts said in the majority opinion. So relief from these tariffs is a tax cut. So here's some dimensioning on that. What we have in these bars on the top of this panel are all of the tax hikes since World War II. And they're expressed as the dollars raised in taxes as a percentage of GDP at the time. Dollars at the time, GDP at the time. And that little red bar is the tax revenues that could be reasonably expected to be raised by Trump's tariffs. It's 69 basis points, almost 0.75% of GDP, which makes it the largest tax hike since 1993. But compared to some of the other tax hikes that you can see here, it's not the biggest. It's in the top half of the chart with the small ones, not the bottom of the chart with the big ones. But look at those dates associated with the big ones. Okay, those were wartime tax hikes when we had Hitler and Mussolini to defeat. So please don't look at the Revenue Act of 1942 and say, oh, well, everything was fine when we had a tax of 5.04%. Yeah, everything was fine because we just basically put ourselves on a wartime footing, and that's what was necessary. This isn't that. 69 basis points as a tax hike is a big one by peacetime standards. The Supreme Court just reduced that to 17 basis points of GDP. This is a major, major, major pro-growth tax cut.
Say, Don, a quick question for you. You said you're calling this a tax cut. Obviously, that's stimulative to the economy and good for individuals. I heard a rumor about tax refunds coming from the tariffs. If you could talk about that, are those still on tap? And then, are we? There's corporations suing to get the money back. So if they're going to get their money back, that could be stimulative also. If these companies got billions of dollars back on their balance sheets. Sorry if you were going to get there.
I was, but I'm very glad to be cute. So so you framed it up really well. It's a twofer, where you not only have a going forward tax cut in the sense that the tariffs you expected to pay you won't have to pay, and so all those earnings analysts on Wall Street who've been figuring out what Costco's and Amazon's and Ford and General Motors and John Deere's earnings were going to be out over the next 8 quarters. They can now assume that there's a big tax expense that they were building in that's not going to be there anymore. So those estimates are already very aggressive, and that's one of the reasons why we have the seemingly high valuations that Brian focused us on. But one of the ways that we're going to justify those evaluations is from this tax cut, which is going to fall straight to the S&P 500's bottom line, because taxes are just corporate expenses. And you take away those expenses, and what do you know? You have higher earnings, right? It's just very simple arithmetic. Now, the refunds. The Supreme Court was the last stop for these tariffs. There were two stops before that. The first one was the Court of International Trade, which is the special federal court that's set up to hear tariff matters. The administration lost unanimously in that, and this was in May, before they'd even started collecting the tariffs. So they announced them on April 2nd, Liberation Day, and they were going to go into effect on June 1st. The Court for International Trade renders its judgment on May 28th, 3 days before the tariffs were going to be collected. And they said, it's over, you can't collect these tariffs. And the government said, well, we're going to appeal this, and we'd like to collect the tariffs in the meantime. And the court said, well, no. And I said, well, okay, here, so court, if it turns out we end up losing, which we don't expect, but if we end up losing, we will refund the tariffs with interest if you'll please let us collect them. So the court said, oh, fine then. So they appealed to the U.S. Court of Appeals for the Federal District. They lost there too. That court said, okay, you got to stop collecting these things. And the government once again said, we will make refunds with interest. So all of these lawsuits that have been lodged at the Court for International Trade, and they're not just from small businesses, the big one in the news today was FedEx. So it's Costco, it's, just all these gigantic companies that are these huge, they're looking at getting billions in refunds. If you put it all together, it's probably about $150 billion. S&P 500 earnings are $3 trillion. So 150 billion is 5% of earnings. Now, there have been plenty of times in that history that Brian showed us when 5% was how much earnings grew. Well, now you just get a bonus of 5% on top of the earnings growth that's already baked in by Wall Street. Now, that's just a one-time event. So you'll get your refund check. It'll drop onto your balance sheet as an asset. It'll just be great, little lucky lottery win of 5% of your earnings. That is stimulative. It's a liquidity event. And right now, it's not exactly like we need stimulus. This economy is booming, but we do definitely need liquidity. I know a couple of hyperscaler data centers that could use $150 billion right now. So, this is, I almost hate to use the word stimulative because that connotes that there is some government puppet master that is deciding to stimulate us or deciding to restrain us. I know what you mean by it. I want to just use a different word. I want to say this is pro-growth. Mm-hmm. Fair enough?
Fair enough.
Okay. So the refunds will be made. The government's promised it twice. They're on every hook there is. The suits are just preventative.
Mm-hmm.
Now, speaking of tax cuts, on July 4th of last year, Congress passed the One Big Beautiful Bill, which was call it $125, $150 billion tax cut for individuals, and another $125, $150 billion tax cut for corporations. And last time we were all together, I showed you this chart, and I said, isn't it nice that all the tax cuts over on the right, so we're just stacking them up provision by provision, isn't it nice that they outnumber the tax hike of the tariffs? So even if the tariffs stick around, we got more tax cuts than we got tax hikes. Well, you see that red box drawn around the majority of the tariff tax hikes? That's the part that goes away now, everybody. So that majority already of tax cut versus tax hike, already in favor of tax cut, it just became practically unanimous. So this is extremely growth positive, extremely growth positive. So let's go on and we'll talk about, unless there are any more questions about tariffs and refunds, let's talk about Kevin.
Well, Don, I just wanted to compliment you. You called this a long time ago. You participated in the behind-the-scenes workings of this case, and you even called 6-3 on the Supreme Court. So kudos to you. So your friend Kevin Warsh, can you, before you go here, you want to just share a little bit about the basics of the Federal Reserve and the Treasury and the differences in responsibility?
Yeah, and it's important to understand those differences because part of Kevin's agenda is to realign the relationship between these two very important institutions. So the Treasury is just literally that. It is the function of the federal government that manages and raises the government's debt. Now, it does a ton of other stuff too, just like all big government agencies do a ton of other stuff. But that's 99% of their mission, and that's 99% of what they spend their time thinking about. They just manage the country's debt. They issue it, they deal with it as a portfolio, they decide whether to issue a 10-year bond or a 5-year bond or a 90-day bill. That's all the Treasury does. The Fed is also can be understood as a narrow institution. The Fed is the nation's top bank regulator, and separately, it is also the federal institution that issues our currency. So if you just reach into your wallet and pull out a $20 bill, you will see that it is called a Federal Reserve note. That is a form of debt of the federal government, and it's the one form of debt that the Fed is authorized to issue. That $20 bill in your wallet, I hate to be the one to break it to you, but it doesn't pay interest. So every time the Treasury borrows money, they got to pay interest. The Fed is an institution that can issue debt called currency that doesn't pay interest. Now, they also do various technical things to support the infrastructure of the economy. They run the wire transfer system, the ACH system, and the Fed wire. That is basically the circulatory system of the banks. They just provide that infrastructure in the same way as your local utility gets electricity to your house. Famously, they meet every 6 weeks to set interest rates. That is part of their bank regulatory process, but they do it under congressional mandate, a law passed in 1978 that tasks them with the very ambitious twin goals of controlling inflation and controlling excessive unemployment. So they are set up to be the guardians of growth. So if a recession happens and unemployment gets out of hand, they're supposed to do things to stimulate the economy, like cutting interest rates. On the other hand, if inflation gets out of hand, they're supposed to do something about that by, say, raising interest rates. So that's the difference between the Fed and the Treasury. Now, Kevin's whole mission is for those descriptions I just gave you to actually be true. And right now, they're not true. That's what they should be. That's what they were until 2008. That's when we had the financial crisis that Brian reminded us of. And in the name of the emergency, the Fed and the Treasury got into bed with each other and started doing each other's job and never got out. So the Fed, as a bank regulator, remember the 2008 crisis was a bank crisis. So the Fed's hands weren't clean, right? Because, you were supposed to keep this from happening. But once it did happen, the Fed had to be the intervener of first resort and go in there and save Citibank and Bank of America. And then the Fed ended up saving institutions that weren't even banks. When they saved AIG and Goldman Sachs, these were institutions that the day before they saved them, the Fed hadn't even regulated them. So the Fed, in order to stimulate the economy when it had to lower interest rates to zero and couldn't lower them anymore, the Fed started so-called quantitative easing, under which it bought trillions and trillions of dollars of U.S. government debt in what turned out to be a vain hope to lower long-term interest rates, having already lowered short-term interest rates to zero. Now, Kevin Warsh joined the Fed in December 2006, about a year and a half before the first foreshocks of the crisis started to be felt. I met him in 2003. I was visiting the West Wing of the George W. Bush White House in March of 2003 to brief the president in advance of kind of the final showdown vote on his tax cut bill. And when you visit the West Wing, does everybody remember that show from the 90s called The West Wing? Remember where Martin Sheen played the president, and it shows all these busy, like hyperverbal people just running around like little bees in a hive in the West Wing? That's exactly what it's like, just exactly what it's like. And Kevin Warsh was one of those busy little bees. And he didn't have a very elevated position, and not really that much more than an intern. He was 30 years old. 3 years later, George W. Bush nominates this nobody to be on the board of governors of the Federal Reserve. And the same day he nominated Ben Bernanke to be the chairman of the Federal Reserve. Really, really amazing. And Kevin barely got through the Senate confirmation process because he was so young. And when he did get through, and he was the youngest Fed governor ever. And, when I met him, like 4 years before that, he's just an outstanding guy who is smart, knows how to get along in the world of Wall Street and Washington. And, so, he got my name in his Rolodex and I got his in mine. And, we've been in touch regularly ever since. That's the way you succeed in life, by the way. Build a network. Just have the biggest Rolodex you can. Just know lots of people. So Kevin got to know me, and in the process, I got to know him. And that's turned out to be a lucky thing. So the crisis hits. Kevin starts working with Ben Bernanke to decide which banks to save and which not, how to do QE, all these extraordinary things. Kevin is an old-fashioned conservative type. He's a Bush guy, for God's sake. He's not a Trump guy. He's a Bush guy. And at that point, when you're all the way back in 2003 and George Bush has only been president at that point for 2 years, if you're a Bush guy, that means you're a Reagan guy. So that's Kevin Warsh. So all of a sudden, the Fed goes from being this little bank regulator that issues $20 bills to holding trillions of dollars of Treasury debt and mortgage pass-through securities. Because remember, the first victim in the financial crisis were Fannie and Freddie. Treasury had to buy them and still owns them. Mm-hmm. So not only did the Fed have to support debt issuance by the federal government by buying all those treasuries, it had to support housing by buying all those mortgage-backed securities. Now, you know that the federal government, through the tax code and a million little agencies, already has 97 and a half ways of supporting the housing industry. So Kevin's saying, oh my God, do we really have to do this here at the Fed? And so Bernanke said, yes, because it's an emergency. It's an emergency. And as soon as the emergency's done, we'll just unwind this. Well, the emergency was done and they didn't unwind it. They did it bigger. There was QE2, there was QE3, and Kevin Warsh quits the Fed in disgust. He went to work for Stan Druckenmiller. Now, for those of you who don't know, Druckenmiller is a pretty famous hedge fund manager, to the extent that a hedge fund manager can be famous. He used to work for George Soros back in the 80s and the 90s. This was when Soros was a hedge fund manager, an extremely aggressive, ambitious, highly successful one. This is before he got into the political game. So forget what you think about George Soros. Druckenmiller is a total old-fashioned conservative who, if he had his way, we'd be back on a gold standard. So he hires Kevin, and they've been together from 2011 till now. So a partner back in the Soros days with Druckenmiller is our current Treasury Secretary, Scott Bessent. So Warsh is just in with this crowd. Now, Bessent has, done everything he can to be a true blue Trump booster. So he wants to be Treasury Secretary. He's got to support his president. It's just a pretty straight boss-employee relationship, and Bessent's doing an honorable job of it. Warsh, on the other hand, has spent all these years kind of as an outsider. Ever since he left the Fed in protest, he's been kind of a gadfly. He writes editorials for the Wall Street Journal criticizing the Fed's, he calls it mission creep. And after the Fed got into like QE 97 and during the COVID crisis, he calls it mission leap. And he's not wrong about that. He desperately wants to shrink the Fed's balance sheet back to where it used to be. That is not exactly Trump's agenda, to compromise the integrity of the Fed and get a guy who's just going to cut interest rates like crazy just because the president tells him to. Right? The president can order the Treasury Secretary around. The president is not supposed to be able to order the Fed chairman around. Now, he gets to pick the Fed chairman. But once he's done that, the Fed chairman gets 4 years to kind of be his own man. That's the way Kevin sees it. So just because he says he wants to lower interest rates now, which of course he had to say or Trump wouldn't nominate him, that doesn't mean he's a hack. I know this guy. He's not a hack. He does want to lower interest rates. I think we should have lower interest rates. I'm not beholden to anybody. Why should we have lower interest rates? Because we are in an economic boom. We need to finance those data centers. We need to finance the energy exploration and production that'll power those data centers and the pipelines that'll get to those data centers. We need to finance the entire infrastructure of the economy when the economy is growing at rates that 4 or 5 years ago people would told you was structurally impossible in our mature state. To do that, you need lower interest rates because you need more credit, you need more money, you need more liquidity. A bigger economy needs more money. A bigger economy needs more credit. Hey, a bigger economy needs more everything. It needs more roads, it needs more schools, it needs more neckties, it needs everything. That's Kevin's insight. He did not show up at Mar-a-Lago and say, Mr. President, what do you want me to do? Oh, okay, I'll cut rates. He goes to Mar-a-Lago and says, here's why we need to cut rates. And he's right. And he's right. So Kevin Warsh is a good man. He is not politically beholden. I don't want to go into too many details here, but I just want to tell you as a general proposition that he did not vote for Trump. He is a Bush guy. The Bush dynasty thinks that the last two presidents should have been named Jeb. They do not like Trump because he's the guy who made that not so. So this is not a Trump guy. This is a Fed guy. No, this is a let's do the right thing guy. So we are lucky, lucky, lucky to have this guy.
Awesome.
How are we doing on time?
We're doing good. We want to talk about AI being the growth engine of this economy. And we got a slide here that I think Nelson's going to mark up a little bit while you go through
Okay,
it.
great.
This was impressive and tells many stories.
Yeah.
And Don, we want to leave 5 minutes at the top of the hour for a little Q&A.
Okay.
Our message thread lit up.
Okay. Well, that's great. I'm so glad to hear that. We're in a productivity-led boom. Now, this is a slightly complicated chart with pretty small letters, so I'm going to walk you through it, and if you'll trust yourself and be patient, in 30 seconds you're going to understand this chart, and it'll really open your eyes. What is the definition of productivity? Productivity is how efficient you are. So if you can produce something in 1 hour, that's great. If you can produce two somethings in 1 hour, that's productivity. So that purple line that runs across the bottom, it definitely has its highs and lows. It's been going up and down. That's the growth rate in the number of hours that got worked in our economy. And you're looking at the 80-year history of this data. They started collecting productivity data right after World War II, so it's an 80-year history. And that purple line is just the growth rate of hours worked. You see that funny little dotted purple line that's almost flat, ever so slightly downward slide? Can you run your cursor across it? There you go. That's just the trend line. So it's so close to flat, we can pretty much say that hours worked in this economy have just not changed. Now, the blue line on top is GDP. Now, typically the way productivity numbers are given to you by the government is they don't look at the big GDP number that they just announced for fourth quarter last week. They look at that component of GDP. It's about 80% of GDP that is just produced by businesses and individuals. They leave out the production of government. Little sidebar. Why does the government leave out the production of government in the government statistics about GDP? Because the government doesn't produce anything. Can we agree on that? Okay, just moving on. That was my editorial. That blue line is private sector GDP, business output. That's been all over the lot too. It's had its highs, it's had its lows. But its trend line, that little blue dotted line that's going from the upper left to kind of the middle on the right, that's downward sloping. That means that GDP growth has been falling since World War II. It's not because it's not necessarily because we're doing anything wrong. It's just that the post-war boom, when America came back from World War II, which was coincident with coming back from the Great Depression of the 30s, that was just a time of rebuilding, the baby boom generation. That was a time of GDP growth that pretty hard to imagine we'll ever see that again. So kind of it's been downhill from there. But now look at that red line. That red line's productivity. Remember what I said productivity was? It's how much you produce for how many hours you put in to produce it. So it's basically the difference between the blue line, which is what you produce, and the purple line, which is how many hours you put in to produce it. So that's been sloping down too, and it has basically the same rhythm as the blue line. Now, what does that tell you? That the red line kind of looks like the blue line, and the red line doesn't look anything like the purple line. It tells you that in this country, all that matters to growth is productivity. This is not a country about just working more hours. This isn't a country where we say, well, we're going to do better if instead of working a 40-hour week, you'll work a 60-hour week. Feel free, but that's not the way we're going to do this. We win in this country by being smart. We're not afraid to change our ways. We're not afraid to take the risk that creating productivity always is. Productivity, if you're going to do more with less, that means you had to try something new to do it. And some of those things you try don't work. And the ones that do work, maybe kind of upset the system. We're not afraid to do that in this country. We never have. Productivity explains 70% of growth in this country. So if you got productivity, you got growth. Now study carefully that red line, please. Would you please, Nelson, highlight that bottom about halfway through the chart on the red line? That's 1983. That was the bottom for productivity growth in this country. Now, please highlight that next bottom over there on the right. That was the second bottom for productivity in this country. They're exactly at the same level. After that first bottom, we launched on a productivity revolution that lasted 20 years. That was 1983. Anybody else on this call old as me who remembers what was going on in 1983? Remember that
Personal
amazing...
computer.
Thank you. Just two little words, and those were the right two. The personal computer changed everything. It took 20 years for individuals and businesses to figure out how to use the personal computer and the microchip that was inside them. But we did, and it just changed the world. And it restored that blue line to some pretty nice high levels that, we're kind of getting into the zip code of the post-war boom. Then the great financial crisis hits, the housing crisis hits, and we go into a 15-year bear market in productivity. Then along comes the pandemic in 2020. That was the turning point. That was the turning point. The productivity was, the pandemic was kind of like a war. It just shut down the whole world. It didn't do it as long as the world was shut down in World War II, and thank God, not as many people died. But that was a shock. When you come out of a shock, it just changes you. You're smarter, and you learn new ways to do things. Like this thing we're doing together right now. We're not meeting in person. We're all in the comfort of our homes, our offices. We didn't have to go outside in the snow. We didn't have to risk our lives driving. Here we are having a pretty substantive interaction with each other. We didn't know how to do this before COVID. We do now. That's doing more with less. That's productivity. That was 6 years ago. And in the middle of those 6 years, AI comes along. That's the PC of our generation. We've got two productivity booms in one. Now, from 1983 to 2005, while that last productivity boom lasted, there were definitely some individual quarters that weren't pleasant. Everybody remember, say, the stock market crash of 1987? Okay, that was a thing. But for 22 years, it was a rising tide. And as Ronald Reagan used to say, a rising tide lifts all boats. So that means, looking at those somewhat high valuations that Brian was showing us before, hey, it's a rising tide, man. Don't be too afraid to buy an expensive boat. On the other hand, a rising tide lifts all boats, as the Gipper said. So maybe the cheap boat's a good idea too. That's going to go up too. So this is a secular environment where you just want to own assets. Don't be too squeamish about which ones you own. You can get away from the risks as to your choice of them by diversification, and Tony can help you with that. But you want to be involved in this market. You want to be involved.
Productivity is having...
Stop and take questions?
Yeah, let's do it. Productivity is getting 50 people to be entertained by you, Don, and not having to buy them a turkey sandwich. We got a question about USMCA renegotiation. What is it, and what's the impact?
Well, it was already renegotiated once. It used to be called NAFTA, and that, by the way, is how you do tariffs. You negotiate a treaty, and you have that treaty approved by Congress. That's the thing, and it's the last time it was renegotiated, when it went from being NAFTA to USMCA. The guy who did it was Trump, and I challenge anybody to tell me what was really different between NAFTA and USMCA, except Trump got a lot of publicity about what a great new deal it was, and the world kind of went on, and the sun came up the next morning, and my coffee tasted approximately the same. And I think the next renegotiation is going to look exactly the same way. I think it's all bark, no bite, all theater, no substance.
Great. There was a fantasy about income taxes going away, being replaced by tariff income. What say you on that one?
Well, I say that question answers itself because you
That's
use
done.
fantasy.
Don, I had one of our business coaches, his son sent me a text. He said, "Can you talk? I'm really worried about the deficit." He's 22 years old, just got his first job. And it seems like a lot of young people and old people are worried about $40 trillion in debt. And when the Democrats spend it, the Republicans get mad. When the Republicans increase the deficit, the Democrats get mad. everybody seems to be spending like drunken sailors. When do we begin to worry about $40 trillion in debt? And are we only looking at part of the picture when we look at the debt?
Sure. Yeah. When let's say, I mean, debt is a very useful tool. It's like, say, electricity. You don't want to live without electricity. On the other hand, you don't want to just stick your finger in the socket. So it just has to be handled judiciously. And you throw those numbers around, and they're accurate numbers. You're not wrong to throw them around, but you set the question up right. All things, even true things, have to be put in context. If you were going to borrow money, say, to get a bigger house, that would make your life better. It might make you more productive, especially nowadays when you need a Zoom room like I have here to do our work from home. You're probably going to borrow to do that. Most people borrow to buy their home. And the bank looks at that debt you go into to buy your home versus the value of the home. That's the collateral. So they look at the loan to value ratio. So when you look at the debt of the U.S. government, and round it to 40 trillion, that's fine. So that's the debt. What's the value of the home? What's the collateral? What's the collateral of the federal government? Well, the federal government owns lots of stuff. I mean, anytime you fly from the East Coast to the West Coast, you fly over those completely uninhabited wastelands that are just all owned by the federal government. So I guess that's something, but I don't see any buyers. The government owns Yellowstone National Park. It could sell it to Walt Disney and raise a couple billion. The government controls various kinds of a spectrum that it could sell to cell phone operators. So, the government has those kinds of assets, but the most important asset of the government is that it has the power to tax. And that means the government's collateral is the earnings power of America, which generates the income that can be taxed. The earnings power of America is pretty much the earnings power of the United States of America, of the S&P 500. Because most people work for a company. It doesn't have to be a public company, but the S&P 500 is a good proxy for the world of companies. The market cap of the S&P 500 right now is, call it $60 trillion. Now let's go back to Finance 101. What is the value of a stock? Or if you put 500 stocks together, what's the value of a portfolio of 500 stocks? It's the present value of all their future earnings. You don't know for sure what they're going to be, but take your best guess. Now, when we talk about corporate earnings, we're talking about after-tax earnings, aren't we? So that $60 trillion in market cap is the earnings power of the industrial sector of the business sector of the United States, already assuming some tax rate is coming out of it. So that's a heck of a loan-to-value ratio on that house, isn't it? Where the house is worth $60 trillion and all you're trying to borrow is $40 trillion? I mean, mortgage bankers would just stand in line to do that loan. This is not a problem. This is not a problem. Is there anything about this as a problem? Well, one problem may be that it's a crummy house you're buying, and the roof is going to cave in, and something terrible is going to happen. Well, I suppose that could happen, but the markets are efficient. And the markets have decided that the S&P 500 is worth $60 trillion. And the markets have decided that the debt of the United States is worth $40 trillion. I'll do that trade every day.
Great. I've got people ordering turkey sandwiches in the webinar chat here, so we'll take care of that later.
Okay, you have my address, right?
Yeah, we'll get a cheeseburger from Texas. So just a couple quick thoughts on geopolitics. Obviously, the hot spots right now are Iran, and the Ukraine has been blowing up for 4 years now. We got half the military might of the U.S. floating around in the Middle East. How do those situations resolve themselves?
I'm pretty sure the way the Ukraine. I'll just go back to 4 years ago what I said on day one about Ukraine. I haven't been right yet, but I'm waiting to. Pretty obvious that Russia's going to win. I mean, you just look at a map lately. I mean, it's just sort of any. The miracle is that Ukraine has held out as long as it has, and it's obviously because Russia has some responsibilities to the court of public opinion, and can't nuke them or be too terribly destructive. But the way this is going to end up, and you can see NATO beginning to agree to this and Zelensky beginning to at least be willing to talk about it, it's going to end up being for territory. And the territory Russia wants, you hear all the time about the so-called Donbass region, which is sort of the right-hand corner of Ukraine. Russia wants more than that. They want that plus the two provinces to the west of that. So they want the provinces of Luhansk, Donetsk, Kherson, and Zaporizhia. That gives Russia a continuous land bridge that connects the continent of Russia to Crimea, which right now Russia can't get to except by sea. So that's their war aim, and you just have to give it to them. That's only 20% of Ukraine's landmass, so Ukraine gets to keep the other 80%, including such tourist spots as the famous nuclear reactor meltdown?
Chernobyl.
Yes,
Chernobyl.
yes, Chernobyl. So that's at the very top end of the country. Russia is not eager to claim that one. So, but that's how that's going to resolve. Iran. Well, we already tried that once this year, and it was a brilliant, brilliant success. Our partnership with the Israeli Air Force pulled off one of the most just amazingly precise, competent military adventures in history. A fantastic exposition of our technological prowess and Israel's intelligence gathering prowess. To pull off that operation, basically, Iran had to be made deaf, dumb, and blind by the Israeli Air Force before we send in our bunker busters. And, well, that's done. Iran is completely defenseless. It's just like a puppy on its back with its paws up. And so we can do whatever we want. There's no risk. The risk, I suppose, is that they could do something obnoxious, like take some big supertanker and sink it sideways in the Straits of Hormuz, in which case we just send frogmen down to dynamite the thing. Same frogmen we sent to dynamite the pipeline connecting Russia to Germany. So we're really good at that kind of demolition. If Iran's oil comes off the markets, the unused spare capacity of the United Arab Emirates and Saudi Arabia put together, which can be brought into the market within a month, is 3 times Iran's entire output. We just got this covered. Remember, folks, there's no such thing as a geopolitical crisis. There's only an oil crisis. This isn't an oil crisis.
All right. Thank you, Don. We went a little bit over. I want to thank Melissa for putting this together, Nelson for making the tech work, Brian for his intelligent investment wisdom, and Don for your wisdom as usual. Just one more thing for everybody at Parr McKnight. We love what we do. If there's anybody that you can think of that might benefit from a conversation with us, we'd love to make time on our calendar for anybody that's important to you. So until next time, we're here when you need us. Thank you all for being with us today. Thanks, Don.
Thanks, Tony,
Thanks,
Brian,
Don.
Nelson. You're great.